Hello and welcome to the Harwood Report for March 19th, 2018. I am Keith Harwood, the founder of Trade Academy and the host of the Harwood Report. Let's go to the disclosures. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Do your own due diligence before entering into any trade. This is just the way that I look at the markets right now. I'm going to talk about the normal stuff here. The equity indices, the VIX, because that's actually a bigger mover today. Bonds, kind of been quiet, but we've got the Fed on Wednesday. Gold, again, quiet. Got the Fed on Wednesday. Oil, been highly correlated to equity markets, and so let's see if there's something going there. And in particular, I do like oil, so make sure you stick around in the end. I'll definitely have a trade idea in the oil stuff. First things first, I think that this is absolutely ridiculous that this market is at such a fear point. I get it. There's some stuff going on right now. There's a little bit of concern that Powell will say something to pull the markets apart on Wednesday because his last time he really spoke was right around that February 5th through 9th collapse mode. I get it. Facebook had some issues with some data that got out, and they don't like that. I mean, basically, the amount of data on individuals that didn't really opt into it, that's a problem. Is that a problem that should take down the whole market? Probably not. Is Powell going to pull back his rhetoric a little bit and try to calm the markets down a little bit? I think so. I mean, he doesn't want to destroy the markets. If he does that, there's no chance of 4 rate hikes. So if he starts talking about a 4th rate hike and it destroys the market, then you can't do a 4th rate hike. If he talks about 3 and basically pulls it back and says, if the situation's right, maybe the market sits there and says, all right, he calmed down his rhetoric a little bit. A 4th is only in the cards if the market lets it happen. And so the market either has to let it happen, i.e. continue higher, or if it pulls back, they're not going to do that 4th rate hike, which then could naturally create flow into the market because that's a source of yield again when there's less yield from the 10-year. So I think that they're going to try to create and weave out more of a Goldilocks scenario as they start talking through the next Fed meeting. The first one with the rate hike and everything else that maybe happen on Wednesday, that could be a little bit rougher than your standard Janet Yellen one because she'd done it for years, but I don't think Jay Powell's an idiot. And then finally, the stuff going on with Russia and Mueller, and it doesn't sound like there's anything crazy changing there, so I'm not sure that that justifies anything. The 3 together seem to have triggered a little bit of selling due to technical levels, and I'll get into that right now. So we start with SPY. SPY basically on Friday closed right at the 50-day moving average. It was slightly below, and then this morning started a little weak, and in particular it was below both the 10 and the 20 or all three, the 10, the 20, and the 50-day moving averages. And that seems to have actually helped trigger this move down where we stopped at the 100-day moving average. Some of this is a little bit funky because of SPY going ex-div on Friday, so their dividend amount was taken out of the ETF's price. But in general, we basically stopped at the 100-day moving average if you use the futures as well. If you look at the futures contract, which is US 500 here, you can see that the close was on the 50-day moving average, and then this morning we got very close to the 100-day moving average and seem to have found a little bit of support here. Are we going to rocket up from here? No, maybe not. I kind of doubt it. But, a repeat of this, maybe 3-4 days to get back to 2750 seems logical. If Wednesday is a calm rhetoric, maybe that does allow for a push to 2800 by the end of the week. We'll have to see how this goes. But generally speaking, I'm not bearish. And I'm looking for a signal that it's a little bit safer to buy. Now that we've tested the 100-day moving average and bounced, if we close above, I think it's safe for me to do a little bit of, tiptoeing into the market. If the market closes below, then all I can think is that we're going down to the 200-day moving average and I've got to get some leverage on the downside. So for now, I'm leaning towards looking for a tiptoe into the market, but recognizing that if we do flush below the 100-day moving average and close below it, we may have some problems. IWM is doing better in general over the last few days. I mean, it had a nice run here, tested new all-time highs, and then pulled back. And it's finding support at the 50-day moving average. So it's doing a little bit better here, but just like SPY, it came down to a key moving average basically and found some support. It's not rocket science by any means, but to me, the fact that these markets are so driven by computer trading means it's not surprising that we're finding support at key moving averages in general. Qs obviously got hit more today because of the Facebook data issues and the fact that the Qs had made all-time highs and had a lot more room to come down. But again, down to the 50-day moving average, and that's where we sit right now. So we're sitting on key moving averages, finding support levels here. Seems to me like now is not a time to panic sell the market. And yet the VIX is kind of telling you to panic sell the market with this move up above 20. So something to be cautious of. Now that said, we're getting movement, so I understand the value in owning some options, some short-dated options. I don't know that there's value in owning long-dated options right here in this higher VIX environment. But that shorter-dated option creating demand puts the VIX into backwardation, which then is a fear signal for the market. So it's something to monitor. We need to see front month put sellers to drive front month fall down and put a floor under the market. And as that happens, then it allows this market to go back into that grind higher into the trend mode. So once we get above 280, if and when we do that, and start pressing towards 284, I think we'll start to see ranges tightening up, not to this point where we were in October or August of last year, but to a point not nearly what we've been seeing over the last couple months. Not looking for $5 moves in any individual day, here or in the Qs. I want to look at one particular trade on this though, because I think it's important. So if I look at the Qs, and note that today's range is over $5. Friday's straddle is under $4. If I go to the 166 straddle, the market on this straddle, one. There we go. Look at this straddle value. It's basically mid-market is $3.95. So we've had a $5 range, and I can buy a straddle for under $4. That seems too cheap for me. I lean towards doing it in the money call side, so have a slight long delta, because if the market recovers, volatility should come down, and if the market falls, volatility should go up. So if I have a slight long delta, that hedges some of my Vega risk, even though it's a short-dated option. So I think that's something that I'm going to be looking at here into the end of the day, is this March 23rd 166 straddle for $3.95. If I can buy that for $3.95 while we're sitting on an inflection point with a new big piece of information coming out on Wednesday that could really move this market, I don't think I'm going to get hurt too bad. It's possible we sit here for the rest of the week, then I lose $3.95. But if we do a full recovery of today's move, we're trading at 171, and this thing is worth $5. So that's how I'm kind of looking at this to start. There's a Q's straddle for $3.95. Now let's look over to bonds. They're chopping ahead of the Fed. They had to get a short covering rally to a certain extent in order to prep for the Fed this week. Now just kind of sitting here, we've got some distance to the lows down around 117. We've got some distance to the next level of resistance around 123. Maybe the 50-day moving average provides some sort of technical level, but this is all about Wednesday. And for me, it's just best to wait till Wednesday to put on an aggressive trade here. There may be some trades in the volatility space, and I'll talk about that in the premium newsletter. But for here, I'm not looking to do anything too major from a outright directional viewpoint going into the Fed's Wednesday meeting. If I go to the dollar, though, again, very choppy, very tight range. This could also have a big move after the Fed meeting on Wednesday, and that could have an impact on dollar yen. So dollar yen has continually failed at the 20-day moving average. A close above the 20-day moving average makes me bearish on gold, below the 10-day moving average, and I have to lean bullish on gold. And if I look at GLD, one thing I'll note from today is that it didn't. Jesus, there we go. It didn't really get a massive bid when people were looking for risk off. So there was not a big risk off move into GLD today, which may surprise some. I think part of that is the fact that we're in a rate hiking cycle and people think that there's no chance that commodities can perform in that cycle, especially if we're going to go towards 4 rate hikes. But the more that equity volatility increases, the less chance of a 4th rate hike and the greater demand then potentially for precious metals. The one that I get a little more excited about than GLD right now is actually an SLV. So you can see that that's basically unchanged today. This level seems to be holding here around 15 and a quarter. And if I go to SLV, the volatility is actually not all that expensive here. So it's up small today, very, very slight. But on the whole, 15.5 or 16.5 or even 17.5 vol is not expensive on a long-term ratio, especially when I compare it to where the VIX is right now, where it's coming up so much relative to its long-term averages. So when I look over at the options here, sort of a natural idea is to be buying some of these April 16 calls for 12 cents. 12 cents, if SLV gets a bid off of the Fed meeting on Wednesday or off of risk off and starts pressing towards 16, I mean, even if it stops near the previous consolidation area at 16.10, those things will appreciate a lot in value. And if we push towards highs 16.50, 16.55, those have a lot of upside potential here for the week. So that's something that I may actually decide to do. I haven't decided yet, but I'm considering putting on some SLV calls prior to the Fed meeting as opposed to waiting until after, just because the R&R there seems like it may be worthwhile. Miners are a very similar story to silver and gold, of course. They look a lot more like silver, I guess, than gold. Gold has stayed up pretty well. GDX is near the lows. GDXJ also relatively close to the lows here. So those are, probably perform a little bit more similar to silver than to gold coming out of the Fed meeting on Wednesday, if there is any big, divergence in their performance. Finally, I want to go into oil. So USO today is basically unchanged. It's above all the moving averages except for the 50-day moving average. And today, they sold it off with equities and it came all the way back to unchanged. So Friday had a very nice full bullish day. Today, it came back with equities trying to press it lower. What I look at immediately is thinking, okay, then if I want to buy equities today, XLE and OIH are great ways for me to do this. And I've talked about OIH having a lot more leverage. And if I look at the volatility in OIH right now, I see a lot more leverage out of being long OIH. So we can see that vol there is 29%. And if I go over to the volatility here, 29% is really, it's not as cheap as it can get. It can get down to 25 pretty easily. 29 is not expensive. Expensive would be, 34 maybe. If I go to XLE, that peak in November in XLE vol was 18%. And right now that's trading at 19 and a quarter. So for me, OIH has a lot more potential here. And when I look at the options here, one of the spots I like is going down to the April 6th. So you can see that the vol premium here, there's a little premium to the very front. April 6th is a little cheaper. I can get these 24.5 calls for like 37 cents. If we have a full recovery from today, we're back above 24.5 quickly. These are definitely worth more than 37 cents. Obviously, they'd probably be worth closer to 60 cents. So that's a really quick appreciation if oil is going to start to separate from the equity markets and pull up oil producers. So that's how I'm looking at oil right now, is the April 6th 24.5 calls for 37 cents. That's it for today. If you want more information, I've got some other premium ideas that I'll be putting out in the Harwood Report. I'll talk about how I'm looking to approach SPY, IWM, some more of the gold stuff, more of the oil stuff, and I'll give an update midweek on Wednesday so that we can see how I'm looking to approach the markets after the Fed announcement comes out. You get the first month for free, so there's no risk to you for signing up. After that, it's $49 a month if you like it and you're getting value out of it. If you're not getting value out of it, you did it for free and you cancel. It's just that easy. Go to tradeacademy.co/Harwood Report if you're interested. If you have any questions, you can always email me, Keith@tradeacademy.co, or call me 312-600-8004. Thanks all and have a great afternoon.